you ever bought a stock after it spiked? Or maybe you sold one after a sudden drop and then you second guessed yourself, was I too late? Or was I too early? Even if you haven't faced this decision yet, chances are there will come a time in your life when you ask yourself one or two questions. Do I jump in on the upward momentum? Or maybe I cut my losses before it drops further? Now, there's no perfect answer to these questions, but today I want to share with you a simple research-backed tool that can help guide your decisions, and it might just save you from a costly emotional reaction. Now, of course, if you have a well-diversified portfolio, you probably won't need to make these calls very often, but sometimes portfolios get concentrated, like when you hold a lot of company stock, for example. Or maybe you just want to take a big bet on a stock with big potential upside. That's where this method comes in handy. The tool I'm talking about today is called the Short-Term Moving Average Distance, or SMAD for short. It was developed by researchers Ko, Wang, and Yang in a recent study, and it's designed to detect when a stock has moved far enough relative to its recent history to suggest that the crowd might be overreacting. Now, a quick note before we get started. This video is for educational purposes only and does not constitute investment advice. Always do your own research, of course. Consult with a licensed financial professional before making investment decisions. All right, let's get started. Our brains are wired to pay extra attention to recent events. Psychologists call it recency bias. In investing, that means that if a stock has been rising for a few days, we instinctively feel like it's going to keep rising. And alternatively, if it's been falling, we expect it to keep falling. Researchers Hogarth and Einhorn formalized this in something called the belief adjustment model. Basically, what this is that people anchor on their current view, and then they use that anchor to adjust only in small steps as new information comes in. Even if something dramatically contradicts our beliefs, we rarely change them all at once. So when we apply that to investing, this explains why short-term price swings sometimes feel more real than long-term fundamentals. And that's exactly where the SMAD comes in. It helps us spot those situations where the crowd might be overreacting, so we don't follow them blindly into a situation that's likely to quickly reverse. If you've ever seen traders drawing lines on charts, that's technical analysis, using past price patterns to forecast future moves. Now, most traders do this casually, often without testing whether the patterns actually work, and most of them lose over time. Serious researchers, on the other hand, put these rules through rigorous testing. It's kind of like doing a scientific study. They examine decades of historical data. They check whether those results hold after accounting for other known effects like momentum or size. Then they test whether a rule works across different market conditions like times of high versus low sentiment. And then they validate it on out-of-sample data to make sure that it's not just a random fluke. Most trading signals don't survive this kind of scrutiny. The SMAD, however, appears to have done so, and that's why it's worth paying attention to. How does SMAD work? It's actually very simple. You take a stock's end-of-month closing price, divide it by its 10-day moving average at month's end, the average price over the last 10 trading days. That ratio is your SMAD. If the stock's price is well above its recent 10-day average, the SMAD is high. If it's well below, the SMAD is low. And here's the key point. You can compare today's SMAD to its typical values over the past year. If it's outside of that usual range, the stock has made a price move that's unusually large relative to recent history, often signaling a potential short-term reversal. In other words, high SMAD often precedes weaker near-term performance. Low SMAD often precedes stronger near-term performance. So think of it as a way to measure when emotions might be driving prices more than the fundamentals. Now, you might be thinking, okay, that's great, but I'm not a day trader. That's fine, and it's true that SMAD isn't about predicting a stock's performance over the next decade, but it is about spotting short-term extremes, and even for long-term investors, that can be valuable in three ways. The first is choosing an entry point. If you're about to buy a stock, SMAD can reduce the risk of jumping in after an overreaction. A very high SMAD often signals that prices are temporarily elevated. Waiting for things to cool off might improve your odds. Second, recognizing panic versus longer term downtrends. When markets dip, it's easy to assume disaster. But if SMAD shows prices have sunk well below their recent averages, that often indicates an overreaction to the downside. This can help you recognize a temporary correction that can be engaged rather than a long term trend to be avoided. And three, avoiding emotional traps. Historically, some of the market's strongest rebound days occur right after steep declines. So panic selling can lock in losses just before a bounce. SMAD gives you a quantitative reminder to anchor your decisions in data, not just gut reactions. So put simply, SMAD doesn't tell you what to hold for 20 years, but it can help you keep cool when everyone else may be overheating emotionally. Now, one important note is that this effect has been observed in individual stocks, but it hasn't been tested thoroughly at the index level like the S&P 500. Indexes tend to smooth out extreme sentiment swings that are sharper in single names. So if you hold concentrated company stock or you want to make a strategic buy, SMAD can provide a useful gauge of whether recent moves reflect extreme pessimism or optimism so you can make more informed choices. At the end of the day, no single signal is a magic formula, but research like this shows how psychology like recency bias leaves evidence in the data. By testing something as simple as a ratio of price to its 10-day average, we can detect that evidence and potentially use it to our advantage. The takeaway isn't to rush into trades tomorrow. It isn't a get-rich-quick fail-safe trigger point. But the main takeaway is to remember that our instincts are often backward-looking, and that stepping back and looking at psychological motivations can save you from costly mistakes. Think about a moment staring at your brokerage app after a big swing. The temptation is there to chase or to flee, and it's powerful. But those recent moves, what feels urgent, are often the least reliable guide to what comes next. SMAD is a reminder that discipline beats chasing heat. By questioning recency bias and grounding your decisions in tested insights, you can step apart from the crowd and, in the long run, avoid costly mistakes. So next time you see a stock spike or plummet, remember, the crowd isn't always right. In fact, they're usually wrong. And having tools like SMAD in your investing quiver can help you navigate those swings with a cooler head. Thanks for watching. If you found this helpful, do me a favor and like the video, subscribe, and even send to a friend whom you think could also benefit from the financial insights like these. The key to successful investing is strategy, discipline, and patience. SMAD is simply one more tool you can use when navigating the vast sea of market data. Happy investing, everyone, and I'll see you in the next video.